Today we are going to be looking into the paint sector of India. It's under the chemical sector, so it's under the paint and coating industry. We have chosen Asian Paints, Berger Paints, and Nerolac for our coverage of the whole analysis. We'll also be covering liquidity, solvency, and efficiency, and profitability ratios for all these companies through FY23 to FY25. If we have to sum them up in few words, Asian Paint is the current market leader, with Berger Paint having the best ROE and being very efficient with their work. Nerolac is the only one which we should be cautious about, since a lot of their profit is coming from non-operating activities. If we look into some key metrics in terms of profitability, uh, Asian Paints leads in both the categories. In gross profit margin, Asian Paints is at 43%, followed by Berger Paints at 40%, and then 35% and slightly below for Nerolac. EBITDA margin for Asian Paints is 19%, Berger Paints it's 16 to 15%, and Nerolac it's 13%, slightly below. If you have to look into some employee and overhead efficiency, Asian Paint spends 7% of its capital on employee cost, and Berger Paint and Nerolac keeps it at 6%. And if we have to look into some other expenses such as advertisement, power, logistics, it's 16 to 17% for all three of the players here. And strategic insight, if we have to look into it, Asian Paints has the edge in terms of their employee, as they have more spend for employees than the other two, and they do not cut corners, and they want to keep the whole strategy as a people driven strategy. The real advantage for all three of these companies lies in how they source the raw material and how they procure it efficiently. If we have to look into the activity ratios for all of the three companies, the CCC, cash conversion cycle, for Berger Paints is the best. It's around 58 days, which lets them reinvest their capital quickly. For Asian Paints, it is around 71 to 72 days, exactly 71.25 days, but they have the best turnover. It's 5.37. For Nerolac, it's 90 days, and Nerolac it gives them a little less time for them to go back and reinvest the money. So for now, Nerolac needs to, step up the game in that sense, and other two need to keep an eye on it.
This slide shows snapshot of shareholder returns for FY25 comparing ROE and ROCE across three major paint companies: Berger Paints, Asian Paints, and Nerolac. Berger Paints delivers steady performance with ROCE at 19.7%, ROCE at 19.9%, indicating balanced returns for shareholders for efficient capital usage. Asian Paints performs stronger with ROCE of 19% with a higher ROCE of 22%, highlighting superior efficiency in deploying capital. Nerolac stands out on ROCE at 23.5%, the highest among the three, although its ROCE at 16.8 is comparatively low. Overall, the chart highlights that Berger offers stability, where Asian Paints and Nerolac demonstrate stronger capital efficiency, with Nerolac leading ROCE FY25. Now, starting with net versus EBITDA, Nerolac shows an unusual pattern in FY25, where the net margin is at 13.6, exceeds the EBITDA margin of 13%, which goes against normal financial logic. Moving to the drivers, this anomaly is explained by large exceptional items and high other income, including approximately 142 crores of other income and nearly 479 crores of exceptional gains, which inflated net profits without strengthening core operations. Under interpretation, the uplift in the bottom line is non-operating and likely one-off. Looking at the peer benchmark, other paint companies follow expected trend where net margin is lower than EBITDA, highlighting Nerolac FY25's outcome is an exceptional rather than norm. Finally, in summary, a higher net margin should not be confused with stronger operations, with operating metrics should be prioritized when comparing companies.
Move forward to supply chain power dynamics, in which we measure using matrix of receivable days versus payable days. Simply, in this we are telling that who is funding the business, the customers, the suppliers, or the company itself. Starting with Berger Paints, which he receivable days of 38 days and payable days of 56 days. This means Berger Paints get paid by customers before it pays the supplier. It creates a positive cash flow in the company, which creates an good working capital for the company, which is a very good advantage for the company. Then there is Asian Paints. In Asian Paints, it has fairly balanced number of payable days and receivable days. Then moving to Nerolac. Nerolac, now the receivable days is 60 and the payable days is 48. This means the Nerolac has to fund the gap from its own cash, which puts pressure on working capital. So the critical insight here is that the larger the payable and the receivable gap, the stronger the bargaining power. The material cost, which is the main part and the biggest cost in the paint business. The key insight here is very simple. Asian Paint pays significantly less for raw materials compared to its competitors or its peers, and that creates a strong advantage for Asian Paints. If we look at material cost as a percentage of revenue, Asian Paint spends about 45%, while Berger Paint spends about 52%, and Nerolac spends about 48%. What does it mean? I mean, in practical terms, what does it mean? So for every 100 rupees of sales, Asian Paint spends about 45 rupees on raw materials, whereas Berger Paint pays 52 rupees for the same raw material, and Nerolac Paint pays 58 rupees for the same material. What does this mean? So this gives Asian Paints and flexibility. If the market prices of raw material fluctuates a bit, it gives Asian Paints an advantage, and also it helps Asian Paints in getting the budget in other expenses like marketing, operations, etc.
My name is Chirayu Jain. Let's start with the hidden risk for these companies. I'll start with what ROE alone hides. Viewpoint analysis shows us that Asian Paints ROE is margin driven, which is profit margin driven, while Berger Paints ROEs are driven by a higher asset turnover, making Berger Paints more agile and asset light. The risk also shows up in efficiency trends. Berger Paints' fixed asset turnover has fallen from 3.7x to 2.5x due to heavy capex investment, which hasn't generated proportional revenues. This indicates short-term capital indigestion. Interest coverage ratio has also declined. While still in the safe zone, it is moving in the wrong direction compared to its peers. So next, let's move on to the sustainable growth potential for these companies. This shows us how fast these companies can grow without using or raising new capital. Berger stands out. With the highest ROA, it has the largest internally funded growth capacity and can scale without stressing the balance sheet. Nerolac, despite a strong balance sheet, is constrained by lower profitability, which limits its organic growth ceiling. Thirdly, let's move on to the solvency and liquidity ratios for these firms. All three firms are financially safe and nearly debt-free. Nerolac is the safest, with very high liquidity, but it also signals ideal capital. Asian Paints and Berger operate with leaner working capital and better capital efficiency. So, in overall, Nerolac prioritizes safety. Asian Paints carries near-term execution risk from the capex increase that has been there, and Berger offers the best balance of efficiency, growth, and discipline.
Coming to Nerolac, it's debt-free, which makes it very safe. But this also means this is low leverage, can also limit returns and attract pressure to use more capital. The key takeaway here could be the solvency is strong across players, but interest cost sensitivity and capital allocation decisions will matter going forward. Now, coming to the strategic positioning, as clearly seen, Asian Paints clearly sits at the top of the thing. It's a star. It enjoys high margins and strong, which gives it a premium valuation. Berger Paints here falls in the cash cow zone. It is operationally efficient, generates steady cash, and offers good return potential. However, Nerolac is at the bottom due to lower margins and efficiency, meaning it needs strategic improvements to stay competitive. So, Asian Paints leads on dominance, Berger on efficiency, and Nerolac is still in a recovery mode. Lastly, to conclude, Asian Paints is the best for investors looking for stability and strong margins. However, Berger Paints is ideal for return-focused investors due to efficiency and faster cash cycles. Kansai Nerolac is safe from a balance sheet point of view. However, but they should be approached cautiously until margins improve. Overall, Asian Paints offers safety and scale, and Berger offers efficiency-led upside. And Nerolac is a wait and watch story till now.